Hi, I'm Jimmy. In this video, we're going to look at the current strength of the US economy. We're going to use different economic indicators to see if we can objectively gauge where the economy stands today and hopefully answer the question, do we invest now or do we wait for the stock market to crash again? Now, we've been doing this, should we invest now or wait for the stock market to crash video for a while. And each time I think we get good information out of the economic indicator data that we find, but generally the answer to the question, do we invest now or wait for the market to crash, usually comes out to be about the same. We should keep investing, but do so strategically. So in this video, I actually want to take that keep investing concept one step further and see if we can identify a sector, maybe two, that could be good to move on right now. With that in the back of our mind, let's jump right in. So our first economic indicator is consumer confidence. And we can see with this consumer confidence chart that it is gradually climbing higher, which I suppose is logical when we consider where we're coming off of from last year. So as the economy is ramping up again, well, I suppose we're not too surprised that consumer confidence would gradually be rising. So I think it makes sense to give this point to the bulls since this is a positive sign for the overall economy. So over on our scorecard here, well, now we can see we've got 1 point for the bulls. Okay, now let's shift over to consumer debt. So we're focusing on two economic indicators here. First is household debt. This is household debt as a percentage of GDP. So higher here is worse. We want this number to be as low as possible. And we can see that there was a big spike back in 2020, which again is logical. But since then, we can see that we have seen some decline in debt relative to GDP. And that's a good thing. But to make this a bit more readable, I think it makes sense to shorten up this time period to just the past 5 years. And now we can see that the current level is where it was about 5 years ago, which again is probably a good sign. We can make the case that this should still be lower, but given how low interest rates are right now, I think that we could say overall, this is fairly good. Since broadly speaking, lower interest rates would naturally lead to more debt. Okay, now with that being said, these are quarterly numbers, so I think we want to be careful about changing our scoring of these numbers too rapidly. These numbers only come out once every quarter, so we really want to see these updated a few times to truly identify the trend. But for now, I think it makes sense to make this a neutral point. So that's on our scorecard here. That's 1 point for the bulls and 1 point for the bears. Okay, now we're shifting over to credit card debt. So this economic indicator is published by the Federal Reserve, and what it does is it tracks what percentage of credit cards are 90 days or more late or 90 days or more behind on their payments. So higher numbers here are a bad thing. And clearly this is a negative sign for the overall economy since this number is in fact rising. So again, when we slide over to our scorecard, I think that this makes sense to give this one a point for the bears. So right now the scorecard is not looking too positive, although that's going to change in a minute. Okay, now we have the Treasury yield curve. So what we want when we look at the Treasury yield curve is we want a normal yield curve. That's an upward sloping yield curve. And basically what we mean by normal is that if we were to borrow money, or in this case, if we were to buy treasuries, if we were to lend money to the federal government for 30 years, well, we should receive a higher interest rate than if we invested for, let's say, just 6 months. And we can see that since March of last year, well, the yield curve has in fact been normal. So if we pause on the current yield curve, well, we can see that the current yield curve shows no signs of inverting. This is the textbook definition of a normal yield curve. And overall, this is a positive sign for the economy. So the bulls are going to get a point for this one. Okay, now let's hit up the job situation. So this is a chart of initial jobless claims going back the past few years. And we can see that the trend has been getting better ever since the giant spike happened at the start of last year. Now, we had this as a neutral point the last time that we did this video. And I still think it's a bit too high when we compare it to what the numbers were before 2020. So I still think it makes sense to give it a neutral point because the numbers are still too high. And if we're curious, before 2020, the average in the 2 years leading up to 2020 was about 200,000 new jobless claims each week. Right now, it's about 400,000 in a week. So again, it's a bit too high to say it's a bullish trend just yet. So clearly this is going to be a point for the bears. But before we jump over to the scorecard, let's look quickly at the unemployment rate. So this is the unemployment rate going back the past 20 years. And we can see that the current level is above where we're typically targeting, but it's not too bad. Overall, I think that this is a neutral point because the unemployment rate, considering where it's coming from, is not that bad as of right now. And considering what we know about the employment situation, where many workers, you're going to get a change in benefits soon, so that might lead to more people taking jobs. I know that there's been a push in many different areas of the country to try to find more people to work. So I think that the unemployment situation, broadly speaking, could be good. So over on the scorecard, well, I think it makes sense to keep the jobless claims as a bearish point and the unemployment rate as a neutral point, since again, I think it's decent enough at this level. Now, I could also see how some people might disagree, and maybe they think that jobs are going to improve faster or slower than I think that they are, and maybe we think that the score should be slightly different. If you think it should be different than the way I'm scoring any one of these economic indicators, please let me know in the comments below. Okay, moving on. Next up, we have housing indicators. So our first point is the price of existing home sales. And this is put out by the National Association of Realtors, and clearly the trend is higher. And generally we could say, okay, great. If we own a house, then the value of our house is going up. In theory, the equity of our house is going up. So that is a positive sign for the economy. But in this scenario, I think it makes sense to give this point, to give the score here a neutral point, because we could also make the case that with housing prices going up as fast as they are, what if we wanted to buy a house? Sure, it's great if you own a house, but what if you want to buy a house, or even if you want to rent a house? Well, that cost is getting more and more expensive, which I would think would be a negative draw on the economy. So in my mind, I think it makes sense to make this a neutral point. But then when we switch over to housing starts, well, housing starts are the number of new houses being built. And outside of the trouble at the start of 2020, well, this is done fairly well, coming off of the lows of the financial crisis, also known as the housing bubble. So I'm not too surprised that this is trending higher, but this is definitely going to be a point for the bulls, since more houses being built will, one, help increase the supply, so that should help offset some of the prices, but also it has a very good ripple effect on the broader economy. And more houses being built means more construction jobs, more plumbers get hired, more electricians, more mortgage brokers. That's good for banks. The list goes on and on. So over on the scorecard here, well, we've got a neutral point for home prices and a bullish point for housing starts. Okay, now let's look at our last economic indicator, and then we'll see what sectors could be best positioned to look further into now. Okay, so next up we have manufacturing. So this is the ISM manufacturing indicator, and the higher the better with this indicator. In fact, anything above 50 implies growth in the manufacturing sector. Anything below 50 implies negative growth in the manufacturing sector. So clearly, when this is up here above 60, well, this is a positive sign for the overall economy. So over on our scorecard, well, this is another point for the bulls. And overall, we've got 4 points for the bulls and 2 points for the bears, and then a few neutral points in there. So overall, I think that things are looking fairly positive for the broader economy. Okay, now, as every astute investor knows, just because we are predicting that the economy is fairly strong right now and looking pretty good, at least in the near term, this doesn't necessarily mean that the stock market is going to move higher, especially when we consider what the S&P 500 or the stock market has done over the past few years. It is overvalued in general, so I think it's a bit reckless to say just because the economy is looking decent that the stock market will continue to do quite good. So yes, I agree with what I said at the start of the video, that I think to answer the question, do we invest now or wait for the stock market to crash? Yes, investing now makes sense, and we should do it strategically. And also if we're dollar cost averaging. If we're dollar cost averaging, just keep doing that. If you're not sure what dollar cost averaging is, I'll leave a link in the description below to a video I did on explaining that. And if the stock market crashes, well, I think it makes sense to jump in and buy more of everything at that point if the stock market crashes. Generally, there's great opportunities there, assuming we're in the financial position to do that when that happens. So in the meantime, I think it makes sense to narrow down our search for where a strong company could be hiding. So what I've done is I've created a chart of the S&P 500 total market index. So this includes almost 4,000 different companies. And basically, this is the average price to earnings ratio for each sector and their averages over the past 5 years. So the colored bar that stands vertically, well, that represents the current price to earnings multiple. Then The average is represented by the red lines going across each color box. Now, I'll probably do a whole video on this type of analysis and perhaps throw some other valuation methods in there. For example, price to sales could be good. Price to book value. I think those would be interesting ways of rounding out our potential opportunities. But right now, since nearly every one of these price to earnings multiple, every one of these sectors are currently trading at a higher price to earnings multiple than their 5-year average, well, it looks like that almost every sector is currently overvalued. There are only a couple exceptions we should be aware of for this type of analysis. First, when we look at the tall blue bar here, well, this is for real estate, and the average over the past 5 years is above 200x, which, while this is technically true, using price to earnings multiple for real estate companies generally isn't that good of a multiple to use. We usually want to use something like price to funds from operations. That's something like that would make more sense. And frankly, the same could be said for the financial sector. Here, I prefer to use something like price to book value. Now, with that being said, one of these sectors that does look very interesting is the materials sector. The materials sector includes companies like Ecolab, PPG, Dow, Air Products and Chemicals, and the list goes on and on. So maybe worth looking closer at the materials sector, especially when we consider what's happening with the broader economy. We saw that there's growth in the housing sector. There's some strength in manufacturing. So these are just some examples that could support the fact that materials could do fairly well. So I think that if we look in this sector, we could find some real potential opportunities. Now, I actually don't have any companies from the materials sector on my personal bucket list. So I want to go and try to find some companies that I'll be personally going, and I'll let you know as soon as I find something. I'll be sure to do videos on them. Now, if you're not sure what companies I have on my personal bucket list, which is basically a list of stocks that I want to buy once they hit the right price. So if you're curious what that list is, well, I recently did a video on that. If you're curious, I got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thanks, and I'll see you in the next video.